Have you noticed that the world's biggest economic warning signs are no longer coming from stock markets? Instead, they are quietly appearing inside government bond markets, political leadership changes, artificial intelligence investments, and even the neighborhoods where new data centers are being built. On the surface, these stories seem completely unrelated. One is about Britain getting another prime minister, another is about AI companies spending billions of dollars, a third focuses on record profits at America's largest banks. Then there is growing public opposition to massive data centers. But what if I told you all these developments are connected by one invisible force that is reshaping the global economy? Stay with me, because by the end of this analysis, you will understand why these events could become some of the most important macroeconomic signals investors need to watch over the next few years. More importantly, you will see why smart money is paying closer attention to bond markets than headline stock prices. Welcome back to Macro Bullion. If you enjoy independent macroeconomic analysis based on facts instead of hype, you're in the right place. Every week, we break down the biggest global economic developments, explain what they really mean, and connect the dots that many headlines leave disconnected. Today is one of those moments when several major stories have appeared at the same time. Separately, they may not look extraordinary. Together, they paint a much bigger picture about where the global economy could be heading. Let's begin in Britain. For the fifth time in only 4 years, Britain has welcomed a new prime minister. In any mature democracy, leadership changes are normal. But when they happen this frequently, investors begin asking deeper questions. Is the political system struggling to maintain stability? Can long-term economic policies survive constant changes in leadership? And perhaps most importantly, will financial markets continue trusting the government's ability to manage rising debt? Political instability is rarely just about politics. Financial markets care less about campaign promises and much more about credibility. Governments borrow money every year to finance public services, infrastructure, healthcare, pensions, defense, and economic support programs. As long as investors believe that borrowing remains sustainable, governments can continue raising funds at reasonable interest rates. But once confidence begins to weaken, everything changes. This is where the term bond vigilantes becomes important. Bond vigilantes are not an official institution or a regulatory authority. They are simply investors who buy and sell government bonds based on their confidence in a country's fiscal discipline. If they believe government spending is becoming excessive or debt levels are rising too quickly, they may demand higher yields before lending more money. Those higher yields increase borrowing costs not only for governments, but also for businesses, homeowners, and consumers. In other words, the bond market has the power to discipline governments without passing a single law. Over the past decade, many governments became accustomed to extremely low interest rates. After the global financial crisis and later during the pandemic, central banks purchased enormous amounts of government debt while keeping policy rates near historic lows. Borrowing became relatively inexpensive, allowing governments to expand spending without facing immediate financing pressure. That environment has changed dramatically. As inflation surged across many developed economies, central banks responded by raising interest rates at the fastest pace seen in decades. Higher policy rates quickly translated into higher government bond yields. Suddenly, debt that once looked manageable became much more expensive to finance. Every new bond issued required governments to pay significantly higher interest costs than they had only a few years earlier. Britain has experienced these pressures more visibly than many other advanced economies. Investors have become increasingly sensitive to fiscal announcements, especially when proposed spending appears difficult to finance without expanding deficits. Markets now react within hours to government policy signals. A single budget proposal can move bond yields sharply, influence the value of the British pound, and alter expectations for future economic growth. This is exactly why political leadership matters today in ways it may not have mattered during periods of cheap money. Every new prime minister inherits not only political challenges, but also the expectations of global investors who are carefully watching every fiscal decision. Markets are no longer asking whether governments want to spend more. They are asking whether governments can afford to. And this is where Britain's story becomes much bigger than Britain itself. Across Europe, North America, and many other developed economies, governments are facing the same difficult reality. Public debt has risen, populations are aging, defense budgets are expanding, infrastructure requires modernization, and the transition toward new energy systems demands trillions of dollars in investment. Yet financing all of these priorities has become increasingly expensive. That growing pressure is now influencing almost every major investment trend around the world. And nowhere is this more visible than in the race to dominate artificial intelligence, where companies are spending at a pace that has surprised even experienced Wall Street analysts. As artificial intelligence continues expanding, the world is discovering something that few people discussed during the early excitement. AI does not exist only inside software. It exists inside physical buildings filled with thousands of high-performance servers, advanced cooling systems, backup power supplies, and enormous amounts of electrical equipment. Every time someone asks an AI model a complex question, processes millions of business records, or generates high-resolution content, those requests travel through data centers that require continuous electricity and constant maintenance. In simple terms, AI may feel digital, but its foundation is very physical. That reality is now creating tension between economic growth and local communities. Across several developed economies, companies have announced plans to invest billions of dollars in building new AI infrastructure. These projects promise jobs, higher tax revenues, and stronger technological leadership. Governments generally welcome these investments because they see artificial intelligence as a strategic industry that can improve national competitiveness. However, residents living near proposed data centers often have a different perspective. Many communities worry about rising electricity demand, increased water consumption for cooling systems, land use, traffic, noise, and the long-term environmental impact. These concerns have led some local governments to consider restrictions or temporary pauses before approving additional projects. Public opinion surveys have also reflected this growing hesitation, showing that a significant share of residents would prefer not to have a large data center built near their homes. This presents policymakers with a difficult balancing act. On one side is the opportunity to attract high-value investment in one of the fastest-growing industries in the world. On the other side are legitimate concerns about local infrastructure, environmental sustainability, and quality of life. Neither side can simply be ignored. For investors, this issue carries an important message. The AI race is no longer determined only by software innovation or semiconductor availability. It also depends on electricity grids, land availability, permitting processes, and public acceptance. Infrastructure has become just as important as technology itself. Energy providers are finding themselves at the center of this transformation. Electricity demand from AI-related infrastructure is expected to remain elevated as more advanced computing systems come online. Utility companies are exploring new investments in power generation, transmission networks, and grid modernization. Renewable energy developers are also receiving increased attention because technology companies are seeking long-term electricity agreements that can support both operational needs and sustainability goals. Yet all of this requires capital, and capital is no longer cheap. Higher interest rates influence every stage of infrastructure development. Building a new data center, expanding a power grid, or constructing additional generation capacity requires financing. When borrowing costs rise, project economics become more challenging. Companies must carefully evaluate expected returns before committing billions of dollars to long-term investments. This brings us back to the broader macroeconomic picture. The same higher interest rates that are pressuring governments through bond markets are also affecting private sector investment decisions. Whether it is a government financing public services, a technology company building AI infrastructure, or a utility expanding electricity generation, everyone is operating in an environment where money carries a higher price than it did only a few years ago. Interestingly, while governments and corporations have been adjusting to this new financial reality, one group has quietly benefited from the change. America's largest banks have reported exceptionally strong profits, with much of the growth coming from activities beyond traditional consumer lending. Higher interest rates have generally increased the income banks can earn from various financial operations, including trading, investment banking, wealth management, and institutional services. Increased market volatility has also created more activity across fixed income markets, foreign exchange, and corporate financing. This highlights an important feature of every economic cycle. Conditions that create challenges for one sector often create opportunities for another. Rising interest rates may increase financing costs for borrowers, but they can also improve profitability for well-positioned financial institutions. As governments issue more debt, corporations refinance existing obligations, and investors adjust portfolios. Banks often play a central role in facilitating these transactions. When these pieces are connected, Britain's political changes, pressure from bond markets, the massive cost of AI expansion, community resistance to new infrastructure, and record earnings from major banks, they begin telling the same story. Global capital is becoming more selective. Investors are demanding stronger financial discipline, better capital allocation, and clearer evidence that today's spending will generate tomorrow's returns. And that shift could define the next stage of the global economic cycle. The final question is no longer whether the world will continue investing. The real question is where capital capital will flow next, and which assets are best positioned to benefit if growth slows while uncertainty remains elevated. That is exactly where gold, monetary policy, and investor psychology enter the discussion. That brings us to the question every investor should be asking. If governments are under pressure, if borrowing costs remain elevated, if technology companies must spend billions just to stay competitive, and if financial markets are becoming increasingly selective, then where does smart money go next? The answer is not as simple as choosing between stocks, bonds, or gold. Professional investors rarely think in absolute terms. Instead, they focus on risk, liquidity, valuation, and macroeconomic conditions. They understand that every economic cycle creates both winners and losers, and identifying those shifts early often makes the biggest difference. For much of the past decade, cheap money was the fuel behind almost every major asset class. Low interest rates encouraged companies to borrow aggressively, investors to take greater risks, governments to expand fiscal spending, and consumers to increase spending through affordable credit. That environment supported rising stock markets, booming real estate prices, and record levels of corporate investment. Today, that financial landscape looks very different. Interest rates remain significantly higher than the ultra-low levels investors became accustomed to after the global financial crisis and the pandemic era. While inflation has eased from its peak in many major economies, central banks remain cautious because they know inflation can return if financial conditions become too loose too quickly. Their primary objective is restoring long-term price stability while avoiding unnecessary damage to economic growth. This balancing act creates uncertainty, and uncertainty changes investor behavior. Institutional investors begin increasing exposure to assets that can preserve capital during periods of economic volatility. Portfolio managers pay closer attention to government bond yields, inflation expectations, corporate earnings quality, and global geopolitical developments. Every policy decision by major central banks receives immediate scrutiny because interest rate expectations influence nearly every financial market. This is one reason why gold continues attracting attention during periods of macroeconomic uncertainty. Gold does not generate corporate earnings or pay dividends. However, throughout modern financial history, it has often been viewed as a store of value during times of elevated uncertainty, persistent inflation concerns, geopolitical tensions, or declining confidence in paper assets. Central banks themselves have increased their interest in gold over recent years as part of broader reserve diversification strategies. That does not automatically mean gold prices move in only one direction. Gold responds to multiple forces simultaneously. A stronger US dollar can create headwinds. Rising real interest rates may reduce its relative appeal because interest-bearing assets become more attractive. On the other hand, financial instability, geopolitical uncertainty, sustained central bank purchases, or renewed inflation concerns can support investor demand. This is why experienced investors avoid making decisions based on a single headline. They focus on the interaction between multiple macroeconomic variables rather than reacting emotionally to daily market movements. Silver deserves attention for a different reason. Unlike gold, silver has a dual identity. It is both a precious metal and an industrial commodity. Beyond its traditional investment role, silver is used in electronics, renewable energy technologies, medical applications, and advanced manufacturing. If global industrial production strengthens, silver may benefit from increasing industrial demand. If economic activity slows sharply, that industrial demand could weaken even if investment demand remains resilient. Understanding this difference is essential because gold and silver do not always move together. Sometimes they follow similar trends, while at other times they respond to completely different economic drivers. Looking ahead, several possible scenarios deserve careful monitoring. If inflation continues moving sustainably towards central bank targets, policymakers may eventually gain more flexibility to reduce interest rates gradually. Lower borrowing costs could support business investment, housing activity, and consumer confidence. Under such conditions, equity markets may continue finding support, although valuations will remain an important consideration. However, another scenario cannot be ignored. If government deficits continue expanding while economic growth slows, debt servicing costs could remain elevated. Investors may continue demanding higher compensation for holding long-term government debt, keeping pressure on public finances. In that environment, financial markets could experience periodic volatility as governments attempt to balance fiscal priorities with investor confidence. A third possibility involves artificial intelligence itself. If AI investments begin generating stronger productivity gains than many economists currently expect, businesses could improve efficiency, reduce operating costs, and create entirely new revenue opportunities. That would strengthen corporate profitability over time and potentially justify today's massive capital expenditures. On the other hand, if expected returns take much longer to materialize, investors may become increasingly selective, rewarding only the strongest companies while placing pressure on weaker business models. None of these outcomes are guaranteed. They are scenarios based on current macroeconomic trends, and markets have a history of surprising even the most experienced analysts. That is why why successful investing depends less on predicting a single outcome and more on understanding the range of possibilities and managing risk accordingly. The biggest mistake investors can make today is focusing on individual headlines instead of the bigger picture. One day the news is about Britain changing another prime minister, the next day it is about AI companies investing billions of dollars. Then attention shifts to record profits at Wall Street's biggest banks or growing opposition to new data centers. Viewed separately, these stories appear unrelated, but when we step back and connect the dots, they reveal a much larger transformation taking place across the global economy. We are entering a period where money is no longer cheap, governments are being forced to justify every major spending decision, corporations must prove that massive investments can generate sustainable returns, and investors are becoming increasingly selective about where they allocate capital. This is the defining characteristic of the new macroeconomic environment. Britain's political changes remind us that financial markets have become far less tolerant of fiscal uncertainty. Bond investors now react quickly to policies that could expand deficits or increase debt burdens. That pressure is not unique to Britain. Governments across the developed world face the same challenge as they attempt to finance healthcare, defense, infrastructure, pensions, and energy transition projects while managing higher borrowing costs. At the same time, artificial intelligence continues to represent one of the most exciting technological revolutions of our generation. Yet every revolution comes with a price. AI requires enormous investments in semiconductors, cloud infrastructure, electricity generation, data centers, and highly skilled talent. Success will depend not only on innovation, but also on efficient capital allocation, reliable infrastructure, and sustainable profitability. The banking sector demonstrates another important lesson. Economic transitions rarely create only losers. Higher interest rates, increased market activity, and greater demand for financial services have allowed many large financial institutions to generate exceptionally strong earnings. Every economic cycle redistributes opportunity. The challenge for investors is identifying those opportunities before they become obvious to everyone else. For precious metals investors, the message is equally important. Gold and silver should never be viewed in isolation. Their performance depends on a combination of inflation expectations, real interest rates, central bank policy, currency movements, industrial demand, geopolitical developments, and overall investor sentiment. There will be periods when they outperform, periods when they consolidate, and periods when other asset classes lead the market. Understanding the macroeconomic environment is far more valuable than reacting emotionally to daily price movements. Looking ahead, several indicators deserve continuous attention. Watch inflation data, central bank policy meetings, government bond yields, labor market conditions, corporate earnings, fiscal deficits, and productivity growth from AI investments. These variables will likely shape the direction of global markets far more than short-term headlines. Remember, successful investing is not about predicting every market move correctly. It is about building a disciplined framework for understanding risk, recognizing long-term trends, and adapting as new information becomes available. Markets evolve continuously, and the investors who survive across multiple cycles are usually those who remain patient, objective, and focused on data rather than emotion. As always, our goal here at Macro Bullion is not to tell you what to buy or sell. Our mission is to help you understand the macro forces driving the global economy so you can make better informed decisions based on your own research and investment objectives. If you found this analysis valuable, make sure to like this video, subscribe to Macro Bullion, and turn on notifications so you never miss our latest macroeconomic updates. Share this video with friends and fellow investors who want to understand what is really happening behind the headlines, and let us know your thoughts in the comments. Do you believe the AI investment boom will continue accelerating, or do you think higher interest rates will force companies to slow their spending? Will bond markets continue putting pressure on governments, or are we approaching another shift in the global economic cycle? We'd love to hear your perspective. Until next time, stay informed, stay disciplined, and always remember that every investment carries risk. Nothing discussed in this video should be considered financial advice. This content is provided solely for educational and informational purposes. Always verify the latest economic data, market prices, central bank announcements, and official reports before making any investment decision. Do your own research, DYOR. The better your research, the better your decisions. Thank you for watching Macro Bullion, and I'll see you in the next analysis.